Good afternoon, everyone, and a very warm welcome indeed to the Q4 2025 edition of the Blackfinch Aim in Focus webinar. Before we begin, it's important to note that the content of this webinar is intended for the professional advisory community, so the details covered today are not intended to be taken as financial advice. I'll now hand over to my colleague Lawrence Campin, Senior Investment Manager at Blackfinch Aim, who will provide you with all the latest insights.
Thanks, Donna, and good afternoon, everyone. There's plenty to cover today after a busy fourth quarter, so I'll start by reviewing the main policies announced in the autumn budget and the corresponding impact of these. We have made some investee company changes in the Adapt AIM portfolios, so I will look to cover some of these before wrapping up with our view on the outlook for AIM. Much like in 2024, investors endured a protracted lead-up to the 2025 autumn budget. So with the rhetoric from the government tilted towards making hard decisions, with repeated mentions of the infamous black hole in the finances, the market declined, pricing in the uncertainty. Rumours around potential tax changes, such as to the tax-free lump sum in private pensions, likely led to increased selling in the market, unhelpful when net fund flows from the UK equity continue to be negative. The budget rate reviews announced can broadly be defined as following a spend now, tax later approach. On the tax side, a range of changes were announced, totaling up to an expected additional 26 billion in tax receipts by 2029-30. This is a material number, albeit below the 40 billion amount in the previous autumn budget. Many of the key tax changes were back-end weighted, as shown on the first chart. The chart shows the trajectory of taxes as a percentage of gross domestic product, courtesy of the Office for Budget Responsibility, or OBR. So the dark blue line takes into account the changes announced in the budget, increasing more sharply compared to the previous expectations. So some of the key tax changes include the freezing of the personal tax thresholds for a further 3 years to 2031, and the introduction of a £2,000 limit to the amount of pension contributions exempt from national insurance through salary sacrifice schemes from April 2029. This will undoubtedly be unhelpful for consumers, though against the previously rumoured changes to the personal tax rates, is arguably a less dramatic change, at least in the early years. It was also announced investors will be subject to higher taxes, with an additional 2% added to the dividend tax, savings and property income tax rates in place from either April 2026 or April 2027. So this, along with the reduction in the cash ISA allowance to £12,000 for the under 65s, in our view further highlights the value of using stocks and shares ISAs, along with the unchanged £20,000 annual allowance. So the Chancellor also announced a raft of public spending increases, totaling 32 billion by 2029-30, many of which are to kick in sooner than the expected tax rises. So this also resulted in spending as a percentage of gross domestic product increasing compared to previous expectations, as shown by the solid blue line on the chart on the right. Notable policies included the scrapping of the two-child limit and reversal of previous welfare decisions. The ending of the energy company obligation will go towards reducing the cost of energy bills by £150 in April 2026, which will be helpful for consumers. So importantly, since the announced changes, gilt yields have remained broadly stable, aided by the increased headroom the Chancellor has against the fiscal rules, which is now up to £22 billion, more than double the £10 billion reported in March. So in summary, while there remain some question marks around productivity and growth of the UK economy, the announced changes in the budget have at the very least removed a material amount of uncertainty, allowing businesses and consumers to plan spending and investment. This has been reflected in the broad-based share price appreciation at the end of the quarter. So turning to the portfolio activity in the Blackfinch Adapt AIM portfolios, we actioned rebalances across both the growth and income portfolios in the quarter. So we'll start with the growth portfolio. We sold out of CVS, the veterinary services provider, in December. So the company confirmed that it expects to move from AIM to the main market on the 29th of January. And so to maintain business relief for clients, we sold out of the company ahead of the move. So CVS achieved a total return of approximately 50% from the beginning of 2025, with shares responding well to the Competition Market Authority review of the UK vets market nearing conclusion, as well as the company's acquisition strategy in Australia continuing to build momentum. So the sale of CVS allowed us to redeploy funds into new ideas, one of which was the investment into PowerProbe. We were able to secure an allocation to the initial public offering of PowerProbe in December, and as shown on the chart on the right, it has been received positively by the market so far. So PowerProbe is a leading developer of automotive electrical diagnostic tools, with revenue predominantly generated from the US, where it is the market leader across multiple key product categories. The company's patented products and technology help professional mechanics quickly understand the source of electrical issues in the vehicle and ultimately saving them time and money. Proceeds from the IPO are expected to be directed towards the opening of a new US manufacturing facility, increasing the research and development spend, and also launching in new geographies, including the UK and Europe. So we believe PowerProbe is well placed to continue its growth journey on the AIM market. Moving on to the income portfolio, we decided to reduce our position in MHA, a top 15 accountancy firm in the UK. So we have held MHA since participating in the IPO in April, and decided in late November that after strong share price appreciation, as shown on the chart, and also for risk management purposes, it was sensible to raise funds for a new idea. MHA is still a core holding in the portfolio, and we believe the solid trading performance and recent acquisitions set the company up well for the future. So we deployed the proceeds into Tristal, a new holding for the portfolio. Tristal designs, manufactures and supplies a range of infection prevention products for hospitals. So the main focus area for Tristal is medical device decontamination, using a chlorine dioxide chemistry with patented delivery methods such as foams and wipes. So these foams and wipes are applied manually at the point of care, with the process taking as little as 2 minutes to complete. This contrasts with competitors, which require semi-automated machines to be used as the final step of the disinfection process, often leading to healthcare professionals spending more time and expense in transporting the medical devices to the location of these machines. So Tristal is the market leader in the UK and Europe, and is making good progress in the US, the world's largest healthcare market. A progressive dividend is paid out, and the company is soundly financed with a net cash balance sheet. So we do believe Tristal is well positioned to continue to take share in a growing market. And that brings us to the outlook for AIM. So valuations remain attractive in AIM and well below historic levels. So this is shown in the chart at the bottom of the slide, which displays the forward priced earnings of the Deutsche Numis Alternative Market Index over the past 9 years, with the current level significantly below the average. So inflation has continued to ease, with the UK Consumer Price Index falling to 3.2% in November. And that reinforces confidence that the economy has moved beyond peak price pressures. So reflecting this, the Bank of England cut interest rates by 0.25% to a 3.75% level in December, and is expected to action further cuts this calendar year, which should be supportive for equity valuations. So uncertainty has been reduced following the autumn budget, allowing businesses to move forward. So we expect takeover approaches to also continue at pace, while valuations remain at this low level. And we are increasingly confident that the IPO market on AIM will continue its recovery in 2026. We also note that in previous market recoveries, AIM companies have materially outperformed larger peers. So while there is no guarantee that this will repeat, we believe the factors discussed in this webinar may be supportive of a long-awaited recovery in AIM. So with that, I will pass back to Donna for the wrap-up. Thank you.
Thank you, Lawrence. Now that's everything for the Q4 2025 AIM in Focus webinar. So thank you, Lawrence, for joining us today, and to all of you for tuning in. As always, should you have any questions on the back of today's content, feel free to contact your dedicated business development manager, whose details are now on screen. These webinars are held on the third Thursday of every new quarter, meaning the next is broadcasting on Thursday the 16th of April at a new time of 9:30 a.m. As always, if you'd like to submit a question prior to the webinar for us to discuss, simply email eventswebinars@blackfinch.com. We look forward to seeing you again in April.